Hey, welcome back to The Dive. The Federal Reserve has implemented the first half-point interest rate hike since the year 2000. And our guest today will deep dive into the rate hike, as well as the jobs report, real estate market, supply chain, oil, nuclear power, silver, and gold. He's been a prominent analyst and advisor on precious metals and commodity markets since the 1970s. The founder and managing director of CPM Group, Jeffrey Christian, is joining us today. But before we bring you Jeffrey's interview, do me one quick favor and just go ahead and smash that subscribe button so we can keep making you these videos. Hey, Jeffrey, welcome to The Dive.
It's great to be here, Cassandra.
Yeah, thank you so much for joining us today. Okay, so the Federal Reserve implemented the first half-point interest rate hike since the year 2000. Do you think that the Fed can get inflation under control with a couple of rate hikes?
Well, I think it's going to be a combination of factors. And when you look at inflation, you have to understand that inflation comes from two areas. One is monetary policy, and the other one is the real economy. The Fed obviously controls or has a heavy influence on monetary policy. I do think that the Fed probably will succeed in sterilizing some of these inflationary consequences. But if you look at what's happening with inflation, part of why we have higher inflation rates right now is monetary largesse. You know, there's a lot of money sloshing around, which is pouring into the real estate market, for example, and other things. But a much bigger part of the inflation that we're seeing right now is supply driven. It's supply shortages and supply chain disruptions and delivery of supplies because of ongoing disruptions at a time when we're not only seeing strong economic recovery, we're seeing significantly stronger consumer and business demand for goods and services than we saw pre-pandemic. You know, I mean, if you look at, for example, US imports last year, they were about 19% higher than they were in 2019. So it wasn't a matter of, oh, we've recovered from the pandemic and the economic lockdown. We have gone far beyond that. So you have very strong demand, and the Fed's monetary policy can quell some of that demand, but the supply side is sort of beyond the Fed's influence. So it's going to have a tough job to try to reduce inflation rates in an environment where you have a lot of supply push on prices right now, and which is beyond its control and is whim to things going on in China and Russia and everywhere else.
Now, yeah, some US companies are warning that COVID-19 lockdowns in Shanghai and elsewhere in China are denting sales and disrupting operations. How do you think that China's lockdowns affect the US supply chain?
Well, I think there are two things. You know, on a short-term basis, yes, the lockdowns are definitely constraining the supply of components and goods and services or goods out of China. And that is compounding the inflationary pressures and also reducing sales of things like cars and electronics to some extent because you simply can't find them. So that's a shorter term factor that's in the here and now. Longer term, I think that there's some political implications that will take time to evolve and emerge within China due to the lockdown and the lockdown's effect on people within China. And I think that that has a longer term implication that really we all ought to be paying attention to.
Mm-hmm. Now, the 30-year fixed mortgage rate started the year at 3.3% and recently hit 5.5%. What's your outlook for real estate?
Well, real estate prices have risen for a variety of reasons. One, again, a big supply-demand imbalance. You had a lot of people moving out of cities and even out of suburbs into exurban areas and smaller towns and such. And that has pushed the price up. But there's also been a monetary push on prices in that you've seen this enormous amount of money generated and put into the economy, not only in 2020, but really since 2009, 2010. And a significant portion of that money is being managed by institutional investors who have started buying houses and entering the rental market. And that's a fundamental shift in the housing industry and market in the United States. And it has severe negative long-term consequences for society. But you've seen maybe 15 to 20% of the home sales in the United States over the last year have been by investors, mostly institutional investors, but also some private investors who are buying these things and converting them to rental units. And that has obviously contributed to the speed at which prices have risen. And then it has a knock-on effect because rents go up, and in most parts of the country, rents are largely uncontrolled. So you're seeing a much higher increase in housing costs as a result of that shift. And that probably is not going to go away, because I don't think there are the political will exists to take that into control and to work on trying to reverse what's really long-term economically destructive trends.
Okay, now private payrolls rose by 247,000 in April, less than expected in the US private sector. Based on the recent job numbers, why do you think that the US labor market remains light?
Well, the labor market's actually pretty strong, and we have twice as many job openings as we have, people looking for work right now. And you also had an enormous number of people who left the job, who quit their jobs going on there. So I think that part of the reason why you've seen a decline in new jobs is that people are being much more selective about taking jobs. And rather than saying, I need a job, I have to do this, I have to take the terms and conditions and salaries that this company is offering, I think you're having job takers be more selective and more counterbidding. I mean, one of the things that CPM Group does for its institutional and commercial clients is we teach them to counterbid when they're selling gold, silver, base metals. And I think that what you're starting to see in the labor market is workers counterbidding, saying, I'm sorry, but I don't want that job under those terms and conditions. And I think that has probably slowed the growth in actual job taking on a temporary basis.
Okay, yeah, that makes sense. All right, so let's move on here. The European Commission has put forward new sanctions against the Kremlin, which will include a 6-month phase-out of Russian crude imports. How do you think that further sanctions will affect the oil price globally?
Well, I may use the term, that's a pretty wimpy sanction. I mean, 6 months from now, this war should be over. So it has long-term implications for the flow of oil and gas on a global basis, in that Europe ostensibly will not be taking Russian oil and gas as much as it has been. That oil and gas will be sold in other parts of the world, probably at a discount because of the sanctions. And oil and gas that otherwise would flow to other parts of the world will probably be rerouted to Europe. Overall, I think it comes at a bad time, because you've seen a number of issues in the United States and other countries that have limited the production and supply of oil and gas, so that combined with those other trends emerging in the industry, you're probably going to see oil and gas prices remain elevated for a significant period of time, partly because of these sanctions. On a short-term basis, talk to me in 6 months. But I think in a longer-term basis, it does have the effect of probably raising the price on a long-term sustained basis.
According to a Kazakh official, Russian retailers are in talks with their suppliers and other parties about importing goods via Kazakhstan, Russia's southern neighbor and close partner. We have to ask, if they push this far, do you think that Kazakhstan will be affected by the sanctions?
Just say, and I would say, I'm not sure how close of a partner Kazakhstan is with Russia. You saw massive anti-government protests late last year in Kazakhstan, and the president called in Russian troops to quell his own people. And so there's a close cooperation between the president of Kazakhstan and the president of Russia. But I don't know that friendship extends to the people. And I don't think it extends to the military, because if you look at it, the Kazakh military, Russia asked Kazakhstan to send troops to Ukraine, and Kazakhstan said, no, we're not that close of friends. It's like asking me to help you move, when we're just really, distant friends. So I think that what you may see, because let's be honest, the Western sanctions have been very porous and very selective. We haven't done anything, for example, about palladium exports, because we need the palladium. And the oil and gas exports have been very slow to have any constraints put on them. There's been all sorts of ways around these things. I think the United States, NATO, and Europe look at Kazakhstan and say, here's a country that actually has been pivoting toward being more cooperative with the United States and NATO. They were actually talking about joint military exercises last year between Kazakhstan and the United States. So I think that the United States and NATO will say, and the EU will say, you know what, we probably want to look the other way in terms of anything and not put any constraints on Kazakhstan, because we're trying to be nice to them, not put them in the same bucket as Russia.
Now, the UK government has outlined a plan to expand the country's nuclear power generation to 24 gigawatts by 2050, or about 25% of the country's electricity demand. Do you think we'll start to hear more stories like this?
I'm surprised that we haven't heard more stories already. I mean, in 1979, I actually wrote a book on electric vehicles, and Stuart Brand, in reviewing it, said Mr. Christian is a shill for the uranium industry and the nuclear power industry. I wasn't, but that was beside the point. And then he came out with an article in, I guess, the Audis, saying that when you look at the environmental problems of fossil fuels and energy and this massive desire for electricity that the world has, and where are we going to get it, nuclear power probably is the least offensive source of bulk electricity available to us. So I guess I was wrong in the 70s about being so anti-nuclear power. So that's Stuart. The other thing is that if you look at nuclear power over the last 50 years, we've seen this massive transformation in the technology. So the United States produces far more electricity than it used to without having built a new nuclear power plant for more than 40 years. And we've done that through improving the technology. And I do think that ultimately nuclear power is going to have to play a role in our anti-global warming efforts. But if you look at it right now, there's this tremendous political and social opposition to nuclear power, so that the International Energy Agency and its projections to 2050 basically have the amount of electricity coming from nuclear power flatlining for the next 30 some odd years. But that is a technology that I think ultimately we're going to have to pay attention to. And shockingly, the British have gotten ahead of the rest of the world in admitting that. Now, that said, France has been a leader for some time, as has India and China and a number of other countries. And you even have some nuclear power plants planned in the GCC region, in oil exporting countries. So there is a desire and an understanding, at least on some levels, that nuclear power is something that we really have to harness. But there is this massive political and social opposition to it right now. So it's going to be slow to make that transition.
Okay, now, Jeffrey, we have to get to your take on silver and gold before we let you go here. The prices dropped sharply this week. What do you think needs to happen for them to leg up higher?
I think that, I think gold and silver are suffering from a couple things. First off, the prices rose very sharply from the middle of 2019 into early 2021. And they've been consolidating. So gold has been consolidating at really record levels. If you look at monthly and quarterly and annual average prices, gold prices are at record levels already. And I think you've seen some investors who had come into gold during that period of time saying, okay, the world is not in as bad of shape as I thought. The stock market is not in that bad of shape. And maybe I should redeploy some of my assets away from the gold that I've been buying into other investments. So I think that that's one of the things that's happening. The other thing is silver has had a similar trajectory, but silver has been overrun by a lot of really nonsensical things. You know, silver's going to $50, $100, $1,500. And a lot of investors have expressed dismay that the silver market's overrun. So, I think there are a couple things that have to happen. One is that the gold and silver markets really ought to get better at marketing themselves to investors and try to find a way to, you can't get rid of those cockroaches that spread conspiracy theories and stuff about gold and silver and outrageous projections, but you can counter them with more effective marketing and more transparency and better information. The other thing that needs to happen is the stock market and the economy need to do better, because people think that the gold price moves against the stock market, but it doesn't. I mean, the correlation is something like -5%. And one of the things that you'll see is when the stock market is high and rising, people will buy more gold and silver because they're wealthier. They've got more of their portfolio in stocks, and they say, I need to buy more gold and silver to rebalance my portfolio. So I think a recovery in the stock market over the next 18 months actually could help stimulate investment demand for gold and silver. And that's the kind of information that the gold producers and the silver producers simply don't get out to investors. And there needs to be a much more effective, rational marketing of gold and silver to investors in order for investors to say, okay, gold's not just for crazy people.
All right. Well, thank you so much for joining us today, Jeffrey, and sharing your insights with us. For any of our viewers that would like to hear more of your commentary before you sign off, could you let them know where they could go do so?
I'll give you several things. First off, our website is www.cpmgroup.com. You can get free reads and free reports and free videos, and you can read about the various books that we produce. We will be releasing our 2022 Silver Yearbook next Tuesday on the 10th of May, and you can find a place where you can register for the online briefing for free, and you can order that book. We have been producing gold and silver yearbooks, not me personally, but the group that is CPM Group started doing research on precious metals in the late 60s, early 70s. And we've been producing these reports since at least 1971. And so that's a good thing. I'll also be at the Vancouver Resource Investment Conference in the 17th and 18th of May, and we will be having one of our open forums, an hour-long open question and answer period. No present. I'm making presentations at the VRIC, but I'll have this 1 hour session where people can just ask questions. There's no formal presentation.
Okay,
so those are some of the things that we're doing.
Perfect. Wow, you're a very busy guy. Well, thank you so much for taking the time to do this, Jeffrey. We'll see you next time.
Okay, thank you. Thank you for having me.
For everybody watching at home, thank you so much for joining us today. We'll be back again on Monday, so don't forget to hit that subscribe button below and the notification bell so you don't miss out.